and how are funds addressing that?
Because index funds have to mechanically hold what is in the index, and those indexes tend to be value weighted, there is, in a sense, more capital flowing to those larger companies. And there is a little bit of academic evidence showing that those larger companies are getting larger as a result. That having been said, I'll stress again that I do think the active funds are out there trying to do the job of price discovery to make sure that there is a balance in the market.
Yeah, so do you think the market will correct this, or do we need legislation to correct it? What's the best take from your research?
To date, I think the active funds have continued to do their job, and so I think we should encourage them to keep doing so.
All right, thankfully, my time's expired, and I yield back.
Gentlemen, time's expired. The chair recognizes our ranking member of the full committee, Mrs. Waters of California, for 5 minutes.
Thank you very much, Madam Chair. I want those watching this hearing to know that Elon Musk is coming for your retirement account. Last month, stock index providers modified their rules so that Elon Musk's SpaceX could be included in their indexes. These are rules that have long kept investors protected from losing money in offerings of new, untested companies. Index rules used to require that these companies stay out of stock indexes precisely because the price of these stocks are volatile and the company's revenues are unpredictable. But with these changes, we now have massive index funds, which millions of American workers and pensioners rely on for their retirement to pursue millions of SpaceX's risky shares. Elon Musk was able to do this because he's a billionaire and a friend of Donald Trump's. These changes would put our working families' nest eggs at greater risk of loss. I commend the S&P 500 for bucking this trend, but we still have more work to do to prevent billionaires and now trillionaires from bleeding American investors dry. Forcing American investors to own shares of companies that are untested is wrong, and Congress needs to act in this regard. Ms. Renta, I commend you and AFR's efforts to get the S&P 500 to hold the line and stop companies like SpaceX from receiving a fast track. Your excellent written testimony discusses this issue. Can you talk more about the negative impact of Nasdaq and Russell's rules changes and whether it is a scheme to get us many retail investors as possible to hold the bag for company insiders and sophisticated Wall Street firms looking to profitably exit their original investments?
Thank you so much, Ranking Member Waters, for your question and for your, we are very grateful for your impactful engagement with S&P on this issue. And your question gets exactly to our concern that SpaceX and other recently public large companies will be fast-tracked into indexes at sky-high valuations, largely divorced from these companies' fundamentals, allowing insiders to cash out at these arguably inflated prices while leaving retirement savers holding the bag. So as soon as tomorrow, SpaceX is set to be included in the Russell indexes, and on July 6th in the Nasdaq 100. And we're thankful that the S&P 500 held the line, and that the millions of working people who are invested in index funds that track the S&P 500 are not going to be exposed to the risk of getting exposure to SpaceX shares before a proper seasoning period.
Can you expound a little bit on who is at risk the most? Talk about retirement investors. What are they at real risk, and what can happen with all of this?
Yeah, so the concern is, you know, as we've discussed, that index funds mechanically follow the index providers. So the concern is that there are trillions of dollars tracking these indexes in index funds that will then buy shares while they're still volatile soon after the IPO. There's plenty of evidence. It's common knowledge that after an IPO, there's a period of volatility in the stock. So the concern is that, especially as these large companies are becoming public at very high valuations that are divorced from the company's fundamentals, that eventually, if there's a market correction, so the share prices more closely reflect the company's fundamentals, then all those retirement savers who are invested in low-cost index funds will then bear those losses. So that is our concern, and why we're grateful that the S&P held the line, and for your leadership in that effort.
Quickly, do you think this kind of modification is highly unusual?
Yes, it is unusual, and the timing is suspect, as it all happened soon before the SpaceX IPO and before the expected other mega AI IPOs of OpenAI and Anthropic that we're expecting.
There's a lot more we could say about this, but my time is up, and I have to yield back my time. Thank you very much.
Thank you, Ranking Member.
The gentlelady yields back, and the chair now recognizes the gentleman from Montana, Mr. Downing, for 5 minutes.
Well, thank you, Madam Chair, and thank you for the witnesses for being here. Really appreciate having this hearing, which greatly impacts the investment and saving decisions of my constituents. A little bit of background, after a career in technology, I started investing in what I knew technology companies doing, basically we called angel financing, seed level financing, and our goal was always to, bet on a company that was going to have a public exit at some point. That was like the brass ring, and later on, started kind of a boutique investment, investment banking group, and did a lot of flavors like, real estate, a lot of Reg D offerings. And then it started to look different, looking at the, publicly trade or non-traded public REITs and looking at some of the other things. And it's just been an interesting to see things evolve and trying to understand, what we can do to better, position constituents for opportunities on whether it makes sense for public offering or private offering and, all these different flavors. So just a little bit of background there. But I'm going to start on the active versus passive fund costs, and I'm going to start with Mr. Patak. We've discussed today that people have gravitated towards passive investing in large part due to the lower fees. So in response, have you seen the fees associated with actively managed funds decrease, or what have you seen there?
Thank you for the question, which is a very good one. Yes, indeed, we have seen the cost of active funds come down, and that's for a few reasons. One is, and so if you're looking at something like an asset-weighted average expense ratio for active funds, I think as of the end of last year,